Welcome back to the deep dive. We're diving deep again, this time into global finance, looking at a stack of sources to really pull out the crucial bits you need. Today, we're tackling something pretty significant, a major economic challenge in Africa, the rapid decline of Nigeria's currency, the Naira. Okay, let's unpack this. Yeah, and this isn't just some, abstract number on a screen. This currency crisis, it directly impacts the price of food, fuel, everything for over 200 million people. And it also changes how global investors view the whole region, doesn't it? So this is a deep dive into, economic turbulence, but also real-world consequences.
That's absolutely right. Our job today really is to get past the headlines. We need to extract the core knowledge about this depreciation, synthesize the causes, understand what it means for economic stability there and for investors looking in, and crucially detail the very real impact on everyday Nigerians. So just to grasp the scale, let's hit the numbers straight away. Right now, late September 2025, the exchange rate, it's about $1 to 1,200 Nigerian Naira, on the open market, that is.
Wow. 1,200 Naira for $1.
Exactly. Now, think back just a few years. That same rate was, what, around 400 Naira to the dollar?
Okay, so
You're looking at a huge devaluation.
Yeah.
Like two-thirds of its value gone in a relatively short time.
That kind of speed, that dramatic drop, it explains why we're calling it a severe crisis, not just a market shift.
Precisely. It's significant.
That kind of shift is just staggering, really puts the magnitude in focus. And look, a collapse like that doesn't happen because of just one thing, right? I want to jump straight into the drivers. From the material we've reviewed, what's the synthesized why? What explains this huge drop?
Okay, if we connect this to the bigger picture, yeah, we could probably frame it around four key factors. They've sort of created this perfect storm. Let's start with the two big macroeconomic ones first. Surging inflation.
And we're not talking a little jump here, are we?
Oh, far from it. When your domestic inflation is consistently running extremely high, often over 30% recently, the currency just loses purchasing power fast. It makes the Naira less attractive, obviously, both at home and internationally. Think about it. If a Nigerian company needs imported parts,
Yeah.
and need way more Naira to buy the same amount of dollars, that just fuels dollar demand and weakens the Naira even more.
That's that classic erosion of confidence, isn't it? But it must be uniquely painful in Nigeria because so much daily stuff like food, fuel, it's tied to imports.
Precisely. And the second big factor ties right into that. Oil revenue instability. Nigeria is, heavily dependent on crude oil exports.
How dependent are you talking?
To put it in perspective, oil usually makes up over 90% of Nigeria's total export earnings.
90%? Wow, that sounds like a massive structural vulnerability.
It is. So when global oil prices swing wildly, or importantly, when local production gets hit, which happens a lot due to, failing infrastructure, oil theft,
Right.
and the main source of foreign currency, dollars mainly, gets choked off. Fewer dollars coming in means fierce competition for what's left. Liquidity dries up, the Naira weakens. It's direct.
That reliance on one volatile commodity, it really is the Achilles heel.
Yeah.
Okay, here's where it gets really interesting for me, though. Beyond market fundamentals, we've got policy, structural issues. What are the other two key factors pushing the Naira down so fast?
Okay, the third one is critical, and it really links to the government's ability to respond.
Yeah.
Foreign exchange reserve depletion. Historically, the Central Bank of Nigeria, the CBN, uses its foreign reserves, its stash of dollars and other hard currencies, to try and stabilize the Naira.
That's their main defense tool, yeah. Injecting dollars when needed.
Correct. But years of trying to defend what was probably an unsustainably high official exchange rate, plus paying for vital imports, servicing debt, it drained those reserves.
So the piggy bank got low.
Very low. And when reserves are low, the CBN just loses its power to intervene effectively. They lose that safety net, which leaves the currency wide open to market speculation, even panic. And we've definitely seen some of that recently.
So basically they ran out of ammunition to fight the decline.
That's a good way to put it. And the final factor, recent policy decisions. These, maybe necessary in the long run, have definitely caused short-term shocks. The sources really highlight key reforms by the new administration, the biggest ones, getting rid of that decades-old, very expensive fuel subsidy and adjusting, effectively floating the official exchange rate.
You mentioned those policy decisions were disruptive, but perhaps necessary. Let's dig into that necessary part a bit. Removing the subsidy, everyone knew it drained billions, right? Needed reform. But the timing, did it just throw fuel on that inflation fire we mentioned, hitting the poor hardest who were already struggling with the weak Naira?
Well, that's the core tension, isn't it?
Mm.
Analysts generally agree, yeah, the subsidy had to go for fiscal health, but the immediate effect, huge inflationary pressure. Unavoidable, really, especially because that subsidy kept transport and energy costs artificially low for so long. So the policy move basically uh, legalized the higher cost of living overnight.
Ouch.
Yeah, businesses saw operating costs jump, passed it straight to consumers. The source material rightly points out these policies got mixed reactions
Yeah.
because that promise of long-term stability is currently buried under immediate financial pain for many.
So putting it all together, high inflation, unstable oil income, depleted reserves, and these disruptive, though maybe unavoidable policy changes, that's the perfect storm. Okay, we've covered the macro view. Let's bring this back down to earth. What does all this actually mean for the everyday person in Nigeria? What are the real, tangible consequences?
Oh, the consequences are immediate and devastating, frankly, hitting households, businesses, right where it hurts. The first major impact, the absolutely astronomical cost of living. As we said, a weaker Naira means imports cost exponentially more.
And since Nigeria imports so much critical stuff,
Exactly. We're not just talking luxuries. We mean basic necessities. Medicines, spare parts for machinery, certain foods, raw materials for local factories. Rising import costs translate directly into intense inflation on pretty much everything. A local baker needing imported flour needs maybe 3 times the Naira now. Prices go up or they shut down.
that explains why you hear about staple food prices climbing almost weekly. It's a daily struggle.
It's a profound chain reaction.
Yeah.
And secondly, there's significant savings erosion. This is perhaps the most crushing aspect for many, especially the middle class. Imagine you're Nigerian, you've worked hard, saved diligently in Naira, maybe for retirement, maybe for your kids' education. The falling value of the Naira just decimates that security, actively dismantles it. Those savings buy less than half what they did just a couple of years ago. It fundamentally ruins life planning.
That feels like a systemic betrayal almost. People who played by the rules, saved their money, are punished the hardest.
And finally, think about business operations, especially SMEs, small and medium-sized enterprises. They're meant to be the economy's backbone, right?
Supposedly, yeah.
But they're facing huge hurdles. They often need foreign currency, dollars, to buy essential raw materials or equipment from abroad. With the exchange rate so high, that cost is becoming prohibitive for many. It just stifles their ability to grow, to hire people, to contribute to the economy. It creates this drag across the whole non-oil sector.
Wow. It paints a picture of really systemic, widespread hardship. Okay, let's pivot. Let's look at the response. Given this incredibly complex mess, these deep-rooted problems, what is the government doing? What are the experts saying needs to happen to actually stabilize the Naira and move forward?
Well, what's fascinating here, I think, is the general acknowledgement that you need both immediate first aid and long-term structural surgery. So, on one hand, the central bank has tried some immediate things to deal with the liquidity crisis. Tightening monetary policy is one.
Okay, can you quickly explain that? What does tightening monetary policy actually mean in this situation?
Sure. Basically, it means the central bank is making money more expensive to borrow. They do this mainly by aggressively hiking the main interest rate. Think of it like slamming on the brakes for the economy. They're trying to slow down spending, reduce the amount of money sloshing around, and hopefully curb inflation by making loans really costly for businesses and consumers.
Got it. More expensive to borrow slows things down.
Right. And alongside that, they're actively seeking international financial help, loans or support to rebuild those depleted foreign reserves, get that safety net back.
Okay, that's the immediate firefighting. But you said yourself you can't fix structural issues like that 90% oil dependency just by tweaking interest rates, right?
Exactly. That's the limitation. Our sources point out that serious discussions are happening about deeper, more fundamental economic reforms, things aimed at tackling the root causes. And economists, financial analysts, they seem pretty much aligned on what those long-term structural fixes need to look like. They tend to emphasize 3 key shifts. First, aggressive diversification of the economy.
Moving away from oil.
Seriously, moving away from it, actively reducing that crippling dependence. Analysts talk about focusing on, say, high-potential non-oil sectors, like organized agriculture, specifically agro-processing for export, or tapping into Nigeria's huge youth population for the digital and tech economy.
Right, creating totally new, reliable ways to earn dollars that aren't tied to volatile oil prices. Makes sense.
Exactly. Second, Significant investment in those non-oil sectors, not just hoping they grow, but actively funding them, developing infrastructure, providing targeted support to build sustainable export businesses. And this needs an environment that actually encourages both local and foreign investment. And third, and this is maybe the toughest nut to crack, strengthening institutions.
Governance.
Exactly. Building structures that ensure predictable policies, that fight the corruption that drains national wealth, and create a stable regulatory system, one that genuinely attracts the foreign capital you need to fund all that diversification. The real challenge here is whether the political will is strong enough and sustained enough to push through these deep, sometimes painful institutional changes.
That absolutely makes sense. More diverse income sources, less reliance on imports, more investor confidence. It all connects. Understanding these dynamics behind the Naira's fall is just crucial, isn't it? Not just for Nigerians living through it, but for any global investor trying to weigh the risks and, well, the potential opportunities if reforms take hold.
It really does shine a light on the broader economic challenges the country faces. And the solutions, well, they aren't quick fixes. They demand sustained political commitment, real institutional transformation. This whole deep dive really shows how the currency's value is fundamentally tied to the overall health, structure, and diversification of the entire Nigerian economy.
And that leads us perfectly to our final thought for you, the listener, to chew on. Given that the key long-term solutions involve such dramatic economic diversification and strengthening institutions, and knowing that recent necessary policy changes, like removing the fuel subsidy, have already caused hardship and met mixed reactions, how might this internal friction, this political resistance perhaps, affect the speed and depth of those vital long-term structural reforms? It really boils down to a question of enduring political will versus crushing economic necessity, something to reflect on. We'll leave you with that thought.